Lock in a historic 7+% yield on your cash with a public bond account. Hello, members, super savers, and bond course fans. I hope you're healthy and well. So this is what popped up in my inbox this past weekend. Yields are falling. Lock in 7.1% yield today, even if the Fed cuts rates. Which, by the way, the Fed did not do at the latest FOMC meeting, as was largely expected by the market given the ongoing uncertainties about inflation, unemployment, potential tariffs, and the economy overall. The benchmark Fed funds rate still stands at between 4.25% and 4.5%. Now, this 7.1% yield from public.com certainly looks attractive at first glance, given where the Fed funds rate currently is and where Treasury yields stand at the time of this taping, all with a 4 handle, as you can see here. But like many of you often ask when you send us things like this, is this offer even legit? So let's talk about the 7.1% yield on Public's bond account. Here are the 3 topics that we'll be covering in today's video. 1. How does Public.com get such a high yield on its bond account? And is it too good to be true? 2. How does Public.com lock in the rate? And 3. What else should you consider before opening a bond account with Public.com? In this section, I'll also talk briefly about whether we would personally open a bond account with them. As always at Diamond NestEgg, this will be our impartial assessment. This is not a video sponsored by Public.com. And as usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How does Public.com get such a high yield on its bond account? And is it too good to be true? As I mentioned earlier, this 7.1% screenshot appeared in my inbox this past weekend. Well, by the time we got around to checking out Public.com's website on Tuesday afternoon, here's where the yield on their bond account stood, at 6.8%, a bit lower, but still nicely ahead of Treasuries. As our Diamond NestEgg regulars hear me say often, one of the fundamental pillars of investing, not just bond investing, but investing in general, is higher risk, higher return, meaning that this above average return on Public's bond account comes with an above average level of risk. And that's what Public tells you. The 6.8% yield is based on a diversified portfolio including both investment grade and high yield bonds, junk bonds. Here's the list of the 10 bonds that produce this 6.8%. And while they contain a good mix of names, some of them are clearly higher risk. And that's the not so secret to the promised returns. You'll need names like Petroleras Mexicanos, I hope I pronounced that correctly, Pemex for short, and other higher yielding sectors such as real estate to get to the advertised yields. So, is it too good to be true? Not if you understand that you are taking on higher risk for the higher return. You should also be aware, though, that if you are willing to take on the higher risk that's shown in this mixture of names in Public's bond account, you could get a similar yield by buying a mix of investment grade and junk bonds yourself and building out a portfolio with a similar risk profile on any of the leading brokerage platforms. Moving on now to the next section of today's video. How does Public.com lock in the rate? So this rate here, as it states on their website, is the current average annualized yield to worst across all 10 bonds in the bond account. These 10 bonds here. The yield to worst is designed to tell you from the beginning the worst or lowest possible yield you can expect as a bond investor, barring a default by the bond issuer. Bond beginners, folks, please refer to Module 8, Video F, on yield to call and yield to worst if you need more details or a refresher. And this rate isn't locked in until you actually make your purchase, because the price on the publicly traded bonds in this bond account will fluctuate throughout the day when the bond market is open. And you will only receive this rate until the first of the 10 bonds matures or is called, because you'll have to reinvest the principal repayment from the maturing bond into a new bond. And you don't know today what yield you will be able to get in the future, which is what the financial markets call reinvestment risk. But back to Public's fundamental promise of initially locking in an attractive yield. For Diamond NestEgg regulars, this locking in mechanism is exactly like locking in the yield on an individual bond at purchase and holding it to maturity. So no magic here either. If you buy a bond and hold it to maturity, the bond will pay you the promised coupon until maturity and repay you the principal at maturity, assuming a no default situation. And you've locked in the return, so to speak. What's different about the public bond account, their secret sauce for lack of a better term, is fractional ownership. Fractional ownership is the basic idea they were founded on. Public sales pitch is that you can start having a somewhat diversified bond portfolio from a minimum investment of $1,000 in their bond account, and they will invest your $1,000 in 10 different bonds with $100 each. But because bonds are usually traded in higher notionals of $1,000 or more, this requires fractional ownership. You don't own an entire bond, but just a slice of it, which makes sense in principle. Please do note, though, that this is not a fund or a managed account. Public does not manage your portfolio for you. Again, it's direct bond ownership, even if in fractions or slices of a full bond. So the credit risk or default risk is yours, and yours alone to monitor and react. And even if the bond does not default, the price of the bond will fluctuate with rate changes. The fact that prices fluctuate on the secondary market every day is not relevant if you hold all the bonds in the bond account until they mature or are called, as I mentioned earlier, because they will repay your full principal in these cases. However, the fact that bond prices can go down as well as up on the secondary market becomes very relevant if you sell before maturity, because you will have to accept whatever the market price is at this point in time. And that is exactly what happens if you withdraw cash from your bond account. Public will sell as many of your bonds as necessary to generate the cash you want. In other words, this bond account, it's not cash, and you are exposed to pricing risk and all the other risks that come from holding bonds. Because when you withdraw money from the bond account, they will sell the bonds required at the then current market price and send you the proceeds from the sale. No more, no less. There is no cash guarantee or anything similar, which brings us neatly to the next section of today's video. What else should you consider before opening a bond account with Public.com? So, we've already covered a few risks of this bond account, namely the credit risk or default risk of the underlying bonds, price fluctuations, and the yield that is only locked in until the first of the 10 bonds matures or is called. All the same risks as for direct bond ownership, except that with Public's bond account, you can achieve diversification across 10 bonds for as little as $1,000. As many of our bond fans know, the minimum purchase quantity for purchasing individual bonds at the leading brokerages can be anywhere between $1,000 and $10,000. So you would have to invest a lot more if you wanted to achieve diversification across 10 bonds, like in Public's bond account. That said, fractional ownership, which is one of Public's key selling points, carries its own risks, including limited choice, less liquidity, and the fact that the securities are not transferable into another account via ACATS. In addition, this stated yield here, it is before fees. For this bond account, Public charges a monthly maintenance fee for non-premium members of $3.99 per month. It's free for premium members, but to become a premium member will cost you either $10 per month or $96 per year. So if we do a simple calculation, $3.99 monthly fee times 12 months makes for an annual cost of $47.88, which equates to a rounded 4.8% yearly fee on the minimum investment of $1,000. Of course, the ratio will look better the more you invest, but then the larger your investment amount, the more you could probably put together a similarly yielding portfolio yourself, if you have the time, knowledge, and inclination to do so. So, depending on how much you're planning to invest and what else you may be interested in purchasing via Public, these fees may not make it worth your while, and you may be better off building your own bond portfolio or ladder with one of the leading fee-free brokerage companies. In addition, keep in mind that the interest earned on the corporate bonds in this bond account will be fully taxable on all levels, unlike interest earned on treasuries in a normal brokerage account, which are exempt from state and local income tax. And let us not forget that treasuries are generally considered the safest, most liquid fixed income investment in the world, unlike some of the names you see on this list. And for those of you wondering about buying treasuries via public, yes, it's possible, but please also note that treasury bills on public are provided by Securities Inc., a registered broker-dealer member FINRA and the SIPC. Yes, you can invest for as little as $100 like you can at Treasury Direct, but GECO charges a flat management fee of 5 basis points per month based on the average daily balance of your Treasury account. This amount will be deducted from your Treasury account on a monthly basis, and Public receives a portion of that management fee as a referral fee. Remember, buying and selling treasuries online via the leading brokerage platforms is fee-free, and you can typically buy at auction and sometimes even on the secondary market for as little an investment as $1,000. Just watch out for the fees whenever you're considering a new investment platform, because they can really put a dent into whatever returns you may earn. Personally, we're going to stick with the likes of Fidelity, Schwab, Vanguard, and E-Trade. If you've been with us for quite some time, you already know that my general preference is for the established leading brokerage firms and banks. They're safe, low cost, and have plenty of investment options, and some even have good customer service and a decent enough app. So why change what isn't broken? That said, if you really want to dabble in higher risk bonds with smaller amounts and the fees work out in your favor after you crunch the numbers, fractional ownership via Public may be a tool you could consider. Public, full name, Open to the Public Investing Inc., is a legitimately registered and supervised broker and SIPC insured, as shown both on their website and on FINRA's broker check. Also, according to their website, Public was founded in 2019 by 2 bankers and have raised $400 million so far in venture capital and have some more or less prominent names among their investors. So, what about you? Are you going to be checking out this bond account with Public, or have you already opened one? Or are you going to continue building out your bond portfolio with your existing broker? Drop a comment below and let me and the community know about your thoughts and any experience you may have with Public's bond account. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to get up to speed fast on bond investing and building out your bond portfolio where rates are attractive, then check out this video here on our beginner and intermediate level bond courses. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of this week. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level course Bond Masters individually. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.